from the trade log. Pretty good trades, nice outcomes, very, very clear pieces of information. And if we look at how it's developed on today's NASDAQ, we can recognize the similar storylines. Now, we can take away the time. You can always check back on the times to make sure you're happy that I'm not showing you anything that's not real. Here's the trade ideas here. This is what we've seen. Now, when you look at that, you're left almost in amazement at the quality of the signals that you're seeing on these trades. It's almost impossible to not have made a lot of money today using this information. You can see the bids coming in. This is the only max buy we've had on this one. We've had some dispersion buys. These X here, and here, and the ick that we got down here, these are implied correlation buys from the dispersion trade side of the markets. So when we've got implied correlations, these are also very important buy trades. We've got the hedge funds number 2 coming in. We've got hedge fund number 1 coming in at this stage here. We've got the max buy here. Then we've got an offer at the top edge that never traded, an offer here, and an offer here. Some ick buyers here, number 2 buyers here, some market maker adding bids here. This has been spectacular. I mean, it's not just good, it's unbelievably good. If somebody came along to you guys and said to you, I'm going to give you a program that's going to pinpoint the bottom edge of the market today, and it's going to pinpoint every new high price, and every single one of those pinpointed price areas is going to make you money, and it's going to cost you $5,000, you'd probably be climbing over yourself for payment programs. You'd probably be climbing yourself and saying, you know what, I love it. You know, 5,000, a bit of a stretch, but let's, how about $1,000 a month for 5 months or whatever? It is worth every single last penny. This trade today went from 400 to 480 for $1,600 per contract in its own right. Costs you about $1 a day for world-class information. Now, whether you decide to use it, whether you decide to understand it, whether you decide to spend any time getting to grips with it is a different question. It's not going to get every trade right. It's not going to be telling us everything. But when you see today's market, considering we've had a big driving market and then we've had a balancing market, when we start fine-tuning into some of these trade signal areas, and I've been absolutely honest with the levels, I've been absolutely honest when the trade signal comes out, you can see it for yourself, you can look back through it, we can't make any of the levels up. And the idea is that these are commercial trade ideas, these are commercial trade levels. And that's why when you look at the background narrative, for example, when you looked at this strong buy coming in from dispersion hedge activity, we tell you to remind you, just so that you do remember, that you're looking to try and trade into a liquidity pool to be the buyer for liquidity purposes. So that's why when we get a trigger, it might not be a trade until we start heading into some price levels, some price liquidity areas. And all we do is we find the nearest liquidity pool, and that's what we should be doing on our charts anyway. So, for example, when this number 2 hedge fund buyer came in, it was at exactly the same price as an aggressive bidder was in the last time. And it seems that this price level obviously has some relevance because we see that narrative. And we asked you in an earlier conversation from yesterday, in fact, to make sure that you keep your charts up to date because it reminds you to look for things, and then we can see this thing that appears here. So when this number 2 trade came in here, it was on this candle here, right? So I'm not making anything up. You can check it for yourself. That's where the number 2 trader came in from. So why is the line down here? Because I was looking at where the liquidity would be for this hedge fund to get involved. Remember, this hedge fund has a lot of business to be traded. They don't have 5 contracts. They've got a lot of size to trade, so they can't trade it going up as a buyer. They can only trade it going down. You understand that? My God, if you don't understand that, we're in trouble, aren't we? They can only trade it coming down into price liquidity. So when I get a trigger here, and it's coming off this little balance area here, and I can see, obviously you can see where the trigger is there. It's 1531 on our trade log. So at 1531 on our trade log here, they're not going to go long here. They haven't bought it yet. So what we need to do is we need to look to the left-hand side and say, where are we going to get paycheck? Well, obviously we've got a liquidity level here. It's not paycheck, but we've got paycheck liquidity here, haven't we? Because that's got two key levels of liquidity. These levels have been taken out on that stop run. So that liquidity is already gone. So the next key liquidity is this one. This is the key liquidity here. So we just mark it on our charts. We can say, well, I've got some paycheck liquidity at that price. And therefore, I would expect if a number 2 or a number 1 hedge fund is going to buy into this, I would expect that hedge fund to buy at that price area. And that's where the buy came in. It's exactly right. It's exactly where the buy came in. Don't believe me? There it is there. NQ, futures bids expected from the number 2 option fund hedger. The timing on that trade log entry was 1531. Right, so there it is. That's exactly the time that we had on that trade, 1531. And so we look at 1531 and we say, right, 1531 is in this phase here. There it is there. And we say to ourselves, right, where are they going to get liquidity for this buy trade? And you look to the left and you say it's going to be here, because we've got a little liquidity pool here, and that's obviously one thing we can mark off our charts. We've got that liquidity pool. But then we know we've got paycheck below a liquidity pool, which is here. 2 liquidity pools, paycheck. 1 liquidity pool, liquidity pool. So we get this idea that this is where the buy trade is going to come in. And it's the same of the max dispersion, guys. It's the same as the implied correlation, guys. They want to get liquidity for these trades. And by getting liquidity, the only way they can get liquidity is to take the price down, to find sellers at lower prices. And the same for these max sellers. The only way the max seller is going to get business done is to take the price up into liquidity pools. That's why it's on the actual trade log narrative. For mean reversal at liquidity pools into ag volumes, it's there to remind you that one of the key requirements of any commercial trade is volume. And then when we see that as a narrative, we can recognize that this was replaced by this implied correlation buyer coming in here. And this implied correlation buyer has had a very good job of rotating price through the narrative here. Very, very nice rotation through the price narrative here from 1550. Now, when we start marking off these, one of the key aspects to any of these narratives, and we can see if we look at the trade log again, just looking for the implied correlation buyers, there they are there, just so that you know what we're talking about here. Option dispersion via implied correlation buyers bidding into aggregate volumes, right? So it's going to be at a low price. So they're buying into these aggregate volumes at 1550, 1551. So we now have that trade. We now have this idea that at 1550, there's 1549.45 there. See it? So at 1550, 1551, what do you think that volume is there? What are you thinking that volume actually is? It's implied correlation buyers, isn't it? And when did it come out? 1550 and 45 seconds. In other words, 45 seconds after the trade log entry showed up on your charts. 45 seconds later, we start seeing that implied correlation buyer coming into the markets. And you're saying to yourself, well, if they're buying it, I might take a swing at some bids here as well. I might take a look at it. I might be interested in anything else that perhaps was showing up at that point. It's unbelievable in terms of its accuracy. It's not good. It's unbelievable. And then at 1603, we started to see one of the challenging trades, because at 1603, it's a number 1 global macro fund. Now, why is it challenging? Because it's into day high. So we've got nothing to the left-hand side, have we? So at 1603, we now have this idea that we've got the number one global macro fund appearing, 1602.45, so it's there. So we're into day highs. So this is going to be a tough ask because we don't have a level to the left-hand side that we can say, well, we've got a sell coming in from the left-hand side. I don't know where it's going to be, but perhaps we've got another way of finding out where the price might be. It's called the measured move, right? So if I was trying to find where offers are, I could then do, for example, a little measured move. That might be useful, right? Because we don't have any liquidity here, right? It is the top edge. So we know that this might be a trade area here, for example, that we could lean against. A little measured move of the last buy side bracket. There's a structure high, there's the structure low of the break higher here. So there's your measured move, and that might be the location of the number one hedge fund. The number one hedge fund came back out at 1604 as well. So at 1604, we got another number one hedge fund coming into the picture again, and we'd imagine it's going to be roughly at the same price. And we follow this process, don't we? Aggressively looking to keep our charts as up to date as possible. And that was it. That's all we got from our main trigger system. That's all we got from our main trigger system was the number one hedge fund was now selling at higher prices. We never got any more max trades after this one. It's very unusual that you get a max correlation sell for dispersion there. And then if a buy comes in here, it'd be very unusual for another sell to come in very, very quickly from one of the dispersion trade desks, because it's the same group of traders that do this as a trade, right? So when we get these dispersion trades, it's almost like a printing press today, isn't it? I mean, look at the trades. I mean, you can timestamp them yourself, guys. You don't have to take my word for it. You can timestamp every one of these max trades, implied correlation trades, number one hedge fund trades. The number two hedge fund's been very inactive today. It's usually the number two hedge fund that we get a lot more activity from, but it seems as if it's the global macro guys at the moment selling top edges. And it looks like it's the option guys buying bottom edges. Well, that's interesting, isn't it? That comes back to that question again from the other day. What about the fact you've got a seller on one side of it and a buyer on the other side? And you say, well, that's just what happened. What do you want me to say? So, for example, imagine volatility was dropping like a stone. So volatility dropping like a stone, you can guarantee that the volatility hedge fund guys are going to be buyers of equities, aren't they? As a rule, they're going to be buyers of equities. But what happens if your Warren line was selling? At the same time as that was taking place, you'd have these Warren line sellers coming in, trading into these areas here, wouldn't you? So which one's right and which one's wrong? Well, it's not about one being right and one being wrong. They're both right, aren't they? They're both right in their own way. Maybe one's buying for the next 5 years. Now, the volatility guy's not likely to buy for 5 years, but the global macro guys buy for 5 years, don't they? So these number one fund trades, these are a lot more open to potential retest because these guys are not short-term narratives, are they? These guys are not short-term narratives. You understand that? So when we look at the 1604 trade here, it's the number one global macro fund. That's not a short-term trader. They don't go in to scalp the market for 5 ticks. They buy or sell into the market because of the bigger macro swings, which means they're far more likely to be very passive top lines. Whereas the number two trade, which took place in here, is more likely to be a short-termer, right? This is more likely to be a short-termer, this dude. And you can see that that's this guy here. Futures bids expected from the number two option fund hedger. Short-term hedging. The number two bidder coming in here. And you can see that that bid was perfect in terms of running it up into the max trade. This isn't good. I don't think. I think it's absolutely unbelievable. And yet, a lot of people don't seem to like it. That's okay. It doesn't make any difference to my life. But the point is, as far as I can see, this has been a printing press today. If you haven't made thousands and thousands and thousands and thousands of dollars finding these key trades, which you would understand if you'd spent time understanding the narratives and watching the narratives and following the narratives, if you'd followed that process and got, cut through maybe some of the noise. I understand there's a lot of noise, but that's because we're trying to find the best, most amazing triggers that we can find, Henrik, right? We're trying to find the ones that really should be very, very aggressively watched, and then the ones that you just pay cursory attention to. But the idea was it was a trade log. It was the phone call you were getting from the back desk, shouting across the pit to do something. Just acknowledging that that guy exists allows me to then think about what's going to happen next, whether it's significant or insignificant. And the idea is that we have to make sure we understand the very significant. And we have had this conversation before. The max trades we told you are very significant. The implied correlation trades are very significant. The number one and the number two hedge funds are very significant, and the rest is noise. It's noise that can build a storyline. As we took a screenshot of one of the trades here, we'll see that this trade here was a screenshot from 1524, and it has 3 trades attached to it. Take a look. There's the 1524 screenshot there. You can see there's 3 trades attached to it, but take a look at all the stories. The market makers are aggressively offering the rally. The market makers are adding offers into premiums above. Watch for book flips. And the max strong offers are coming in. 1524. So we see at 1524, there's 1524 candle. Show you where the 1524 candle is. There's 1523.45. So the 1524 candle came in there, right? That's when you got the information. Right there. That's when the information was known. Now, what did we tell you when this is traded? Now, take a look at and read what it says. I'm not asking for a miracle. I'm just asking you to read what it says at that point. Adding offers into premiums above, right? Dispersion hedge activity. Look for the liquidity pools with aggregate volumes. So where is the liquidity above? Is that not a line here? Is that not a line you could draw in the charts, every single one of you? Is that not something we all have the ability to then say, well, there's the sell? Or are we all too stupid? And therefore, as soon as we see that trigger, we sell at this price here. And then we moan. But it went up instead of down. Yeah, did you not read the narrative? Are you that daft that you can't read the narrative and understand what it means? Well, you've got to bloody well do the education then, haven't you? It tells you what it tells you on the script. It tells you what it does on the tin. Take 2 a day or you'll get a bloody sore head, right? And all of a sudden you get this idea that that is not a sell trade. That's not a sell trade. It tells you it's not a sell trade. It tells you it's going to be a sell into aggregate volumes above us. So we start looking for that aggregate sell into volumes above us at 490s. And that little trade itself was worth $600. This is a 15-second chart, guys. That was worth $600 on a single contract, that one sell. And then we got the number 2 hedge fund coming in. And that number 2 hedge fund took us up to the next max trade at the top edge. We never really ran the sweep on the max. That was disappointing because the max came in on this drop here. So it was difficult to get the max liquidity, which is why I haven't, really paid a lot of attention to this one, because it never really gave us any liquidity sweeps, because one would have imagined that we were probably going to sweep this key liquidity here, didn't we? So when it never happened, you're probably saying, well, we'll pass on this one. And we passed on it. We eventually got a little sweep. It came in here, as you can see in the background. So you can see if I just draw a line against that liquidity pool there, we did finally get it. But that was quite a distance. That was quite a time after the original max signal. Now, if we got a second max signal, we might have been very, very, very excited about getting that little liquidity pool into that narrative, right? We made her get very excited about that liquidity. And obviously that liquidity was then reversed into the implied correlation buy trades that we got reversing the market back out again. And the takeaway from that trade was pretty good. Absolutely pretty good or unbelievably good. Well, obviously I'm biased. I mean, of course I'm biased on these narratives, but I think they're pretty damn rootin' tootin' good. I think they're pretty close to as good as it gets. I mean, is there anywhere else that you've been able to see a buy here and a sell here and a sell here and a sell here and a buy here, bottom of the tick price, and a sell here, top tick price? Is there anywhere else you've been able to find that information for $1 a day? It's made you thousands of dollars today. Thousands. And yes, when we're running into top edges like this number one trade here, we're running into the top edge, we've got to be a lot more careful, right? We've got to be a lot more careful because we don't know where the liquidity is in the short term. It's in an open space. So we've got to be really careful to sell into these high prices. Now, let's take a look. So you can see that into the high price, we started to see at 16.23, a whole raft of triggers here. We got the number one, the number two, and the max sellers all coming in at 16.23. All coming in at 16.23, right? So if we look at where 16.23 is, there's 16.22, there's 16.22.30, there's 16.22.45. That's the candle, isn't it? That's the candle, because that candle closes at 16.23. So at that point there, now this is into day high, so we don't have any liquidity to look at. We don't have any way to analyze this trade. But at that point there, can we all agree we've got a number one trader? Can we agree we've got a number two trader? And can we agree we've got a max trader, right? So when we draw max in, we look at that price and say, well, where am I going to get liquidity? We've just got some liquidity. We've definitely got some big chunky volumes. But obviously you're going to look at, trying to look at that and say, well, 525.25 might be realistic for that max volume because we are into day session highs. So we just have to drag a line in a box into that area and put it on the charts on the right-hand edge. And recognize that this is not an easy sell. It's not going to be an easy sell, is it? So you need to stack some more information in our favor. There's some trades that are easy. This buy trade here, for example, was easy because it was into the prior swings. We've got target prices of weak sellers. We can go after that weak seller very, very aggressively. We can make a lot of monies by doing that. And that's what we start seeing. I mean, there's other things we can add to this, by the way. We had, hold on a second. We had, for example, the market makers aggressively bidding at 16.13. Well, the 16.13 aggressive bidder is this retest here, right? There's the aggressive bidder coming in. So we know that that aggressive bidder was on the max as well. You can see it for yourself. 16.13. Equity market makers are now aggressively bidding the short-term downtick. Well, that's an easy trade because it's inside value for a test of weak traders at the top edge, isn't it? So that's an inside value buyer, and that's a far more powerful trade narrative here to try and run the liquidity back towards these number one hedge funds. And you can see this trade turned, look at how that trade's turned out, guys, on the right-hand edge. Is that not unbelievable? Nearly 20 points already, guys, in that little trade. It's $400 for anybody that's counting up the numbers. Nearly $400 profit on that trade in the last trade. In the last trade. On the right-hand edge of your charts. It's almost unbelievable it's that good, isn't it? It's almost, you would look at that and say, nah, there's nothing that can be that accurate. Nothing can be that accurate. But there it is on the trade log, there it is on your charts. If you've kept your charts up to date, that's what it would look like for today's business. If that is not borderline unbelievable, impossible even, to have came out with all of those trades in those locations, you see the value and the power of knowing this stuff. Now, as I said, it doesn't mean that it becomes a trigger. It's not a trigger. It is not a trigger. We're obviously aware that it's not a trigger. We are aware that we still have to put in a little bit of work towards these key levels. We're aware that we still look to try and figure out what else we need to add into these as processes. But my goodness, if we can get even close to getting the right trade in those areas, look at how sensational life can be, guys, as a trader. And there we go. Look, we've now just traded 495 from a sell at 15s, $400 now in profit on that short sell live on the right-hand edge. Live on the right-hand edge, because you can see it for yourself. You can see the boxes. You can see the trades. So when you see that as a storyline, you're thinking to yourself, my God, join the dots. Recognize the weakness of this top line. Recognize it as a weak top line. Recognize it as weak selling. Recognize that if we're going to sell it, we're selling it at higher prices. Well, look at the number one traders. Look at the max traders. What are they doing? What are they actually doing? They're selling at higher prices. Now, that tells us about how to draw the chart properly, doesn't it? Because we need to drag the offers into those higher pools, which means we end up with a chart that looks a little bit like this from these number one hedge funds here. A chart that looks a little bit like that, isn't it? Yeah. But the interesting thing is the global macro guys that are selling are just taking profits on their buys, perhaps. You know, it doesn't tell us whether they're getting net short. It doesn't tell us whether it's now a big net short position or whether they're just taking some money because we've had a big rally and it's coming into year-end balancing. You know what I mean? So there's always an idea that we still have to form a story around perhaps what we're seeing. But my goodness, guys, this alone has been sensational again today. And we've covered this now several days in a row. And when you look at that there and you say to yourself, my goodness, if I just knew about those levels, I'd have made a fortune today trading equities. And yet you did know about those levels, didn't you? You did know about those levels. You already knew that those trades were on the charts watching. It's just another dispersion trader, Miguel. So it's similar to the max dispersion, guys, but these are implied correlations, right? So there's two different signals that come in from the dispersion desks that are really important to us. There's the implied correlation dispersion traders, and then there's the normal baseline correlations. And the implied correlation guys come in here and here, and they've driven that storyline to the upside at the moment. It's been unbelievable. Absolutely unbelievable. Possibly the best set of triggers you've ever seen in your life. And that's me being serious. For one day solid there, this is almost unbelievable. If you don't think it is, that's up to you, but I think it is. And I've been in this game for over 40 years. And I don't think there's anything out there that's even close to these as triggers. Not even close. So we can recognize that there's a lot of power by just getting the narrative right, by understanding the narrative, by considering the narrative. And when we do the second class, you'll start to get a little bit of more of an input into the idea that's happening. And you can probably all agree with me already that based on this morning's class, you already see why we got what we got today. It's almost impossible not to see it when you've done the classroom this morning. So there we go, guys. The trade log in all its glory. Understanding the concept of selling into weak top lines at higher prices and aggressively attacking those top lines from rotations off of downtick phases. It's not about getting one trade right. I'm not saying that every single one of these would be a buy or a sell trade. I would imagine that the majority of them will be, but not all of them. Not all of them. So what we've got to try and do is we've got to try and cut through the stories, cut through the narratives, and try and add an idea behind this with regard to things like the price of volatility, for example. And if we try and add in the price of volatility, you can see why some of these trades became more troublesome. But you can see with the price of volatility, how amazing that sell was, that buy trade at the bottom edge was. It's just unbelievably good. How amazing this number 2 hedge fund was. I mean, I don't particularly like any of those sells. Right? I don't particularly like any of them. I certainly don't like the number 1 hedge fund selling here. I love this aggressive buyer here, and I don't particularly like the max sell here either. I love the implied correlation buyer here, and I love the number 2 hedge fund buyer here. And I love the max buyer here, and I love these aggressive bids here. Not mad keen on any of the sells. Any of them. That's absolutely do fine. There's no issue with that. There's no problem with that. You don't have to look at it from a, this is it, this is all I need point of view, because it's not all you need. It's not all you need. You don't know why they're selling it. You don't know if they're getting short or long. You don't know if they're closing or whatever, whether they're hedging. I mean, a lot of these trades are hedges. They might just be short term in their nature. Well, this is a very short term chart. It's a 15-second chart. So when we look at this, we can start to see this as a storyline. When we look at this as a process, we can start to understand the process. I can understand what you're saying, Miguel, but I don't think the value is in back testing. I think the value is in forward testing. Forward testing. So that we can see in real time what we would be seeing, and we can draw the liquidity in real time into where the liquidity would be. Whereas in back testing, it's easy to figure that out because you can see what the reaction was, and therefore it can cloud your understanding, it can cloud your judgment. I think it's always 1,000 times better if you forward test this in real time. Just like we did for that max signal up there, it was a top line sell in real time. We knew where the liquidity was. We told you it'd be challenging because we're selling into today's high. We know it's going to be challenging, and yet there it goes. We still were able to get a nice rotation. Because you've got to be able to see this stuff in real time. You've got to be able to see the narrative evolving in real time so that you're understanding the auction process, you're understanding where you are in the bigger picture of things. And we can see it. We can understand the process. We can understand the narratives. But then again, Ab, if you're doing it each day, you don't need to do it the weekends because it's already on your charts. You don't have to even bother seeing it because it's on your charts already, and your charts will last for a whole weekend. They'll last for as long as you have them on your screens. So I can look back at this knowing that these were real in real time. I can look at these signals and I can say, yep, that worked out good, didn't it? It encourages you to get on your charts and do the work as close to real time as you possibly can. And I think that's really, really important because you know how you're feeling, you know what the sentiment is, you can tell whether that's against the sentiment at the time, you can sense whether you were nervous about that sell coming in. You know, we're not asking you to sell these, we're asking you to mark up your charts, right? We're asking you to mark this level 1 and 2 seller. I'm not asking you to put a sell order in here. I'm asking you to acknowledge that that's what the trade log told you to do. Mark off the sell. What I'm asking you then to do is start thinking about whether you would sell into that as a narrative. And I've already told you, I don't really like any of these sell trades. I've told you that. So I'm not making anything up. I could claim that I would love all of these sell trades and I would have been brilliant on every single one of these rotations, but I don't like any of the sell trades, actually. I really like the buy side. Really like the buy side. So think about it. It's got an incredible importance in terms of finding these trade ideas. And it's just about marking your charts and then understanding how important it could be for your trading going forward. So we're going to take a little break, guys, a little break, and then we'll come back and then we'll get into today's actual main class, which is auction theory. 60 seconds, guys, 60 seconds.